Hello everyone and welcome back to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, bringing to you people the solution for the last Section C question that we are left with of the PM pre-June 2025 mock exam. The name of the question is J Company and this pertains to the transfer pricing aspect unit of our syllabus. Let's get started. Now, whenever you get started off with any section C kind of a question, the very first step that I always tell you people to do is have a look at the requirement. So only the first requirement is visible to us in the first go. So here I can see that for 6 marks, I'm supposed to discuss the objectives of setting a transfer price and how a suboptimal transfer price can distort the performance assessment of the divisional manager. I have to also illustrate my answer with examples from J Company. So that means not only do I have to give general points that what are the objectives of setting transfer prices and how, if the transfer price is not the correct one, how it can lead to a wrong performance assessment of the managers. At the same time, I also have to include examples from this particular scenario, J Company, if I really want to score marks in this requirement. So no general answers, but I will have to link each and everything to the scenario. So let's give the scenario a read. J Company produces a unique type of industrial paint and a special chemical KQ that it uses in its paint and sells to other customers. The company comprises of two other divisions, P and C. Division C manufactures chemical KQ for Division P and for other external customers. Division P combines the KQ it buys from Division C with other materials and it sells the finished paint product to external customers only. So only Division C is the one which is selling internally also, whereas Division P only sells to the customers outside of J Company. The following information is available for both of the divisions: selling prices, external price, internal price, cost per liter, monthly fixed overheads, divisional net assets. Then we are given with the maximum annual capacities, the demands. Division P also same information. The current transfer pricing policy issued by the head office requires Division P to buy all of its KQ from Division C. That means it's mandatory to buy everything from inside. We are not allowed to go outside of the business to buy KQ, which means Division C cannot meet its external demand. So that means not only is Division P restricted to buy all of the raw material from Division C, at the same time, because we are buying from Division C, they are not even able to satisfy the total of the external demand that is possible. Then you see, let's have a quick look at what is the external demand for Division C. Division C has an maximum annual capacity of 2 million liters, and their annual demand that they have to do outside is 1600, 1.6 million. So that means if we have to supply internally, how many units do we have to supply internally? 1.2 million. So out of 2, if I give 1.2 inside of the company, that means I only get to sell 0.8 million units, 0.8 million liters outside of the company. So I obviously sell at a higher price externally. So being Division C, I would not really like it that I have to sell majority of my units at a lesser selling price, which is 4.6. So let's move ahead. The Division P manager has found a supplier for an equivalent chemical to KQ that it can be purchased at $4.4 per liter, and she would like to switch to this particular supplier. Division C manager is unhappy that she needs to supply Division P at lower price before meeting demand for external customers. So this is what we had just seen, that they were selling internally at a lower price. So this division will also not be satisfied, because if they go out actually and sell it outside, they can generate greater revenues. And at the same time, Division P also is not happy to buy from them, because externally they are able to get it for 4.4, and if they buy internally, they get it at 4.6. So this is also a bad thing for the other division. Both divisions are not happy. Then let's have a read further. Head office has now agreed to allow both divisions more autonomy in choosing suppliers and setting the prices as long as the group's profits are maximized. A new transfer price of $4.35 per liter was proposed, and the managers of both divisions accepted it. J Company's divisional managers are assessed by residual income, and their cost of capital is 10%. So we had to, now coming back to what we had to discuss over here, were the objectives. So we have 4 objectives. I've already typed out the answer so that I can just explain the answer to you people and it does not take up much of our time. So the first objective that you people would have learned with respect to transfer pricing is we want to achieve goal congruence. What do we mean by goal congruence? Whatever is the goal of the organization, the managers should also be working on the same goal. They should not be prioritizing their own division over and above the entire company as a whole. So the transfer price that you should be setting, it should be that price which is motivating managers, both of the divisions managers, to maximize the profits not only for their own division but also for the group as a whole. So for example, if you see over here, division C has some spare capacity. How much spare capacity do you have? If you meet out your external demand, division C has a maximum capacity of 2 liters. External demand is 1.6 million only. That means if they meet out their external demand, still they have a spare capacity of 400,000 liters. So this spare capacity can be used to produce KQ cheaper than the market. And then this transfer price that you should be setting, this should be such a price which should be motivating division P also to buy the spare capacity from division C rather than the market. So in the market, if it was available for, let's suppose 4.4, which they had identified, maybe if I have spare capacity because we belong to the same organization, I can be willing to offer them the spare capacity which I would not have been able to sell out outside at maybe just the variable cost. So such a transfer price can be worked out. So it could be 1.2 plus 1.8. This is the total of the variable costs. This is going to give me $3. So if I offer to sell them instead of the market price of 4.4 at 3, division P is going to be very happy. Similarly, it's going to help the entire organization to be able to achieve more and more profits. So this is the first objective. Second objective that we have pertains to the autonomous decision making. What do we mean by autonomous? It comes from the word autonomy. Autonomy means to be able to take your own decisions and not having to listen to anybody else. When you're your own master, that is what is autonomy. So over here, the transfer price should be set in such a manner that head office does not have to tell the divisions what to do. If the transfer price that you set is ideal, if it matches for both buying as well as selling division, head office will never have to tell them what to do. They will not have to impose the decisions on different divisions. Transfer prices should be set in a manner that each of the division's manager should be taking decisions that are able to independently maximize their profits. For example, how could you relate it to the scenario over here? The policy that they should be setting over here is that division C should be allowed to choose their supplier independently rather than being told what they have to do. The next objective that you people can talk about is the fair evaluation. This is the third objective. Fair evaluation means that every manager's performance should be something that is fairly evaluated. No manager should feel that the transfer price is being unfair to them. So for example, the transfer price should be should give both the divisions some amount of profit. It should not be like one person is taking away all the benefit and the other person is facing losses because of that. So it should not be a punishment for one person and a reward for the another person, another division. So for example, over here, if we take the transfer price as the variable cost, then division C is definitely going to make profits, but division P is going to end up making losses. So the manager of division P is going to find that this is unfair. This is not fair to them. The next objective that you people can talk about is the fair evaluation. This is the fourth objective. Fair evaluation means that every manager's performance should be something that is fairly evaluated. No manager should feel that the transfer price is being unfair to them. So the manager of division P is going to And then we have now spoken about the objectives of transfer pricing. Now we will address the second part of the requirement. Whenever you see the word and in the requirement, you people should get very careful that there's something else to answer also. So the second part that we are being asked here is, how will a suboptimal transfer price, a wrong transfer price, an unfair transfer price assess the performance assessment? So for example, if P is forced to buy internally, division P, if they are forced to buy internally, their costs, they will be thinking that they are artificially high, because if they have to buy internally, they have to pay 4.6. But if they buy externally, they can get the same thing at 4.4. So what they are going to think, the manager of division P is going to think that I have to pay, out of my choice, not out of my choice, but out of being compulsion by the company, that I have to buy it from internal. So that means my costs are artificially high. I will think that my profits will be lesser because my costs are high. As a result, my residual income will be lesser. And because the performance is assessed by residual income, my bonus also will be lesser. And this will also imply a bad thing for division C. Why? Because division C is forced to sell to division P at a price of 4.6, whereas if they go to the market, they are able to get it at 4.9. So even division C will be feeling bad because they are going to be selling at a lower price. This means a lower revenue and also a lower residual income for the division C. So this is what is going to happen. This is how the performance assessment can be distorted. The managers will think that it's not fair to them. Their performance is not being correctly evaluated. It is distorted. Distorted means when usually it's used for an image. When an image is not very clear, we say it's a distorted image. So distortion of performance assessment would mean whatever way I am assessing the performance of the manager is feeling that the performance assessment is not proper. Proper numbers have not been taken, because for P it was unfair because costs were higher. For C it was unfair because they had to sell at a lower selling price. So this is how we are going to frame our answer for the first 6 marker of requirement. Now we are going to head forward to the second requirement pertaining to this question. This is a 14 marker requirement, wherein they are asking us to prepare a statement showing the profit of both of the divisions. Let me just reset all of the numbers so that I can show you the calculations from scratch. We're supposed to prepare a statement showing the profit of both divisions and J company and the residual income for the divisions under the existing policy as well as the new policy. Where appropriate, your sales and cost figures should be split into external sales and interdivisional transfers. And then we are also supposed to comment upon our results. So this comment we should not forget. We have to show the profit as well as we are supposed to show the residual income. So this we have to show for both conditions, the current policy as well as the new policy. So first we are going to get started with the profit and residual income under the current transfer pricing policy. So we'll put the heading profit and residual income under the current transfer pricing policy. So this is the heading that I put. Then I start off with the particulars. Then I put in the first division. The first division that I would put is division P, division C, and then I have to take J company as a whole. So this is all of the performa that I have created. Profits, whenever we want to calculate, we start off with the revenue. We will first show the internal revenue and then the external component of the revenue. So now if you talk about division P only sells outside. How much do they sell outside? External revenue will be 1.2 million liters multiplied by how much do they sell? They sell it at 13.5. So this is what the revenue of division P is going to look like. Now, if I talk about division C Division C sells externally also, internally also. So they sell 1.2 liters internally, 1.2 million multiplied by, they sell it at 4.6. So this is the internal revenue. And if you talk about the external revenue, the total capacity that they have is 2 million liters. Now they have already sold 1.2 within the organization. So that means they are only left with 800,000 liters, which they sell in the open market at 4.9. So this is what their external sales is going to look like. And whenever we show our revenue or cost, we all, for the entire company, we always ignore the internal workings. So the total that we will show for J company, we will only find out the sum of the external revenue, which will look something like this. The next thing that we have to do is take into account for all of the costs. Firstly, let's show the transfer that we have done. So internal transfer that we have put forward. Division P has paid up this much cost. So this is the internal transfer which J company has actually paid for. Now, since we are showing costs here, we can start putting negative signs. Then the next thing that we are going to put is go division wise. So for division P, I see that they are incurring other materials from external vendors. So I'll say externally purchased materials, or you can say other material. Other material that division P pays for, so they are manufacturing 1200,000 and the other material that they get is for 2.3. So this is what they must be paying for the external material. You take this also as a negative figure. Then the next thing that they have to pay is for the direct labor cost. So the direct labor cost also is $2.30. So we can copy paste the same number. This is exactly what is my my direct labor cost also. Now, if we do the sum till here, we are going to be able to find out the total of the variable cost. So the total variable cost will be this plus this plus this. So it's going to be this much. And then I can find out what we call as my contribution. How do we work around the contribution? It is the revenue plus the cost minus the cost. So because we've already taken it as negative, that's why I'm using the plus symbol. So this is what my contribution is going to look like for division P. The next thing that I will have to do is take away the fixed costs. So the fixed costs are also given to us here. Monthly fixed overheads for division P are given to us as $265,000. So I take this also in subtraction, minus $265,000. And then after you take away the fixed costs also, you are left with the profits. So the profits for this division are going to be these many. And now that I have my profits all worked out, okay, so these are monthly fixed overheads. Wait a second. We are supposed to take for the entire year. So we are going to multiply this by 12 to find out the annual fixed cost. So this is what your profit is going to look like. And then we do not have to stop at just the profit. The managers are evaluated over residual income. So for the residual income, I have to subtract the imputed interest from my profit. Imputed interest is going to be 10% multiplied by the capital employed. The capital employed for division P is given to us as 17.1 million. So this is what we are going to take. This is what we are going to subtract from here, put a negative side. You take away the imputed interest, so the residual income for this particular division is going to look something like this. $270,000 will be the residual income for division P. Now let's do the same working for division C also. Division C did not have any internal transfers, so we will only take for the total of the costs. So other material that they incur is 1.2. In total, they are manufacturing 2 million units. So that means this is what their cost is going to look like. I'll just put in the minus sign also. Then let's take for the labor cost. Labor cost also, instead of 1.2, I'll make it 1.8. The entire calculation remains the same. So this is what they are going to be spending for the labor. Variable cost, we can put the formula, copy paste, and then for the J company as a whole, we're going to show the sum of both of these values. So this is going to be the total of all of the costs. So here, the sum formula is not going to work because we have used the total of both of these. So how we can find out the total cost? We can put the sum formula over here because we do not have to include the internal transfer. This amount includes this internal transfer. Hence, I have taken the sum from here. So this will be what the total cost looks like for J company. Now we can find out the contribution. You can copy paste the formula. This is what the contribution is going to look like for this, for J company. Contribution is going to look like this. So this is what the contribution amounts are going to look like. For the division C, we have, okay, we did not take up the total of the sales. So we also have to adjust the formula a little bit for them. The total sales have not been taken up. This is what the total sales for division C will look like. So now this is what the contribution numbers actually come to. Now we will take away the fixed cost for division C also. So the fixed cost monthly is given to us as 140,000 minus 140,000 multiplied by 12. This is what the annual fixed cost is going to look like. And then if I take up the fixed cost for the entire J company as a whole, this is what it's going to come to. And then for profits, I can simply take up my contribution and take away the fixed cost from there, copy paste the formula which I had used for the other division. So this is what it's going to look like. Same copy paste for your J company as a whole also. So this is what the profits are going to look like. Next, we are going to calculate the imputed interest. For this particular division, the divisional net assets are 16.5 million. So 10% multiplied by 165,000,000. So this is what the imputed interest is going to look for them. And now the residual income will be somewhat this. So it's $110,000. So this is what we leave our answer at for the very first requirement where we are talking about the current scenario, existing policy. Now we are going to do the same working for what the profit and residual incomes are going to look like when we talk about the revised policy, when we talk about the new policy. So we will put profit and residual income under the new transfer pricing policy. So this is what we are going to put, and the format we can copy paste. This is what we can take away directly to our workings below. And then the next thing that we are going to talk about will be the revenue. So let's see. The revised policy that they have told us about is that according to the revised policy, they are going to be given freedom. They are going to be given autonomy as long as the group's profits are maximized. So what are we going to do here? In the second scenario, under the revised transfer pricing policy, the people are going to agree to sell only for the spare capacity. So how much is Division C going to sell them internally? Division C has a spare capacity of 200 minus the maximum annual external demand of 1600. So that means only 400,000 liters is what Division C is going to supply internally. Internally, they are going to supply at what price? The same price that they did earlier times 4.6. So this is what is going to be your, okay. Okay, a new transfer price has also been given to us in the scenario as 4.35. So we need to multiply this by 4.35. This is what both of the managers have actually agreed to. So internally, this is what is going to be the sales of Division C. Now, if I talk about Division P is going to continue to have the same sales. I can also copy paste the number from above. So this is the amount of sales that they are going to be having. If I talk about the external sales of Division C is selling now whole 1600,000 units multiplied by 4.9 is their external selling price. So this is what their revenues are going to look like. So what is the total revenue going to be? Total revenue for both of the entities is going to look something like this. And then if you want to show the total revenue for J company, it's only going to include these two numbers. So this is what the total revenue for J company is going to look like. You can copy paste this number from here. This will be the total revenue that we show for the entire company. Now we move ahead to the second aspect of our workings, which is about the costs. So with respect to costs, internal transfer that they have taken, so Division C has sold to Division P. So that means this is the cost for Division P. Now, if I talk about the external purchases, so let's talk about the external purchases now. The other material. What is the other material going to look like? Let's see, for Division P, we have the other materials coming to 2.3. So equals minus 2.3 multiplied by 1.2 million. So this is what they spend. And then they also spend, for direct labor also the same amount. Direct labor also, it's the same actual amount. Then the next thing that you're also going to consider is the external purchase of the chemical that Division P will now be doing. So external purchase. So only 400,000 is what they are able to get internally now. So the remaining 800,000 is going to be taken from the external supplier, which they had found at $4.4. So this is what they get the external purchase at. This is the material cost for this particular division P. Now we are going to show the totals, and let's also do this working until, okay, let's find out the total of the variable cost first. We'll show the totals later. We can just use the sum function. So this is what the total cost of this particular division is going to look like. Now I'm going to find out the contribution. Contribution is going to be revenue minus all of the variable costs. This is what my contribution will look like. That if I talk about my fixed costs will be the same. So I can bring in the numbers from the top. This is what my fixed cost is going to be. Now, if I take away the fixed cost from my contribution, I will get what we call my profit. Then if I talk about my imputed interest also I can bring in from my above workings. This is what my imputed interest looks like. And then I can find out finally my residual income, which is going to be the imputed interest taken away from my profits. So $530,000 is what my residual income is going to look like. Now let's do the plotting of the costs for Division C also. Division C is purchasing 1.2 from outside minus 1.2 multiplied by 2 million units that they are manufacturing. Then same, I can just do the modification, make this number 1.8 so that I save myself from the trouble of writing so many zeros again and again. Now, this is all the variable costs. They are not having any internal transfers. They're not having any external purchases. So the total of the variable cost is going to look something like this for this particular division of mine. Now, I can show the total workings for the company as a whole. Also, J company, internal transfers are not shown. Other material, I will total up. I will also total for my direct labor. I will also total for my external purchases. So the cost of the company is going to look something like this. So this is the total cost that we show for J company as a whole. Now talking about the contribution, you can copy paste this formula. Contribution is going to look something like this. Now if I want to talk about the division, the J company as a whole, this is what the contribution is going to look like for J company as a whole. Now I'm going to take away the fixed cost. Fixed cost is going to be the same. So I can bring in my working from above. This is what is the fixed cost is going to look like. And then I can find out the total of the fixed cost for J company as a whole. And now I can work around the profit. I can simply copy paste the formula. And this is what the profits are going to look like. And then I can take away the imputed interest from this. Imputed interest is going to be absolutely the same. So I take up the same number from above, and the residual income is going to look something like this. So this is what the residual income is going to look like for this particular division C. Now, to beautify our answer just a little bit before we head forward to the commenting part, what we can do is we can put this in a nice table. We can try putting our answer in a nice table format. So how do we put it in the table format? We are going to uh, go to the format button. So this is the format window. I go to cells, I go to border, and I select a border style. Then you have to check all of these boxes, vertical, horizontal, click on OK, and then your table is all made. And what we can do is the final answers we can also do in bold. So this is what the profits are going to look like. And the residual income is also our final answer. So I'm bolding that also. So this is what my final answers are going to look like. Similar formatting I can do for the other table also. And with respect to numbers, if you people want, you can also put them in the terms of dollars. So this is what it's going to look like. Right. So this is what our calculations look like. The profits, if you see, they have increased in the other scenario. Uh, let's put the same formatting over here also, at least for the numbers, so that we are able to draw a comparison. Okay, so I select the currency format, and this is what it's going to look like. So if you have a look at the profits, the division P earlier made a profit of 1980. Right now it's 2240. This is what the profits look like. And what about the residual income? Compare the residual income also. Okay. So residual income in the previous scenario, 270. Now 530. Residual income in the previous scenario, 110. Now 250. Both divisions are doing better. And what about the overall company as a whole? 3740. Profits have risen to 4140. So now this information is going to help us frame the answer for our comment part. So in the comments, we are going to say the new transfer policy, new transfer pricing policy has actually improved the profits for both the divisions also, as well as the group as a whole. So it's an improvement definitely over the previous policy. You can also find out how much the profit has increased. So we can give a little bit of these numbers also. We can say that the new transfer pricing policy, the new transfer pricing policy has led to an increase in the profits and residual income for both divisions. The profit of the group also has risen. How much has it risen? Let's work out the number. Earlier, okay, so how do we work out the change? Increase is what you find out. This is the amount of increase, and you divide that by the initial amount. This is the initial amount. So you're going to find that if you convert it to a percentage, this is roughly an 11% increase. So you can say that the profit of the group has also has risen by 11%. So the new transfer pricing policy is definitely an improvement over the previous policy. The objectives of transfer pricing have been the objectives of transfer pricing of fair evaluation, fair assessment, goal congruence. And what was the other one that we had written? It was autonomous decision making and autonomous decision making have been achieved. So everything that we wanted to do is now done. So this is a good transfer pricing policy. The company can go ahead and make this particular change. So this is how we are going to answer the very last requirement worth 14 marks in your paper. I hope that this video helped you get a greater insight as to how we can do our workings for questions like these. All the very best for your exams. I wish that you people succeed the exam with really good marks. I'll see you in the next video. All the best, guys.